Good afternoon. I'm Brent Wilsey with Mace Chase Wilsey. We're from Wilsey Asset Management. And what's today's Smart Investing Daily Briefing? Today we're talking about, do you remember the Nifty 50? Now this started back in the 60s, kind of came to a dramatic end, we'll call it in the early 70s. And what this was, about 50 stocks, and they're kind of known as the one decision stocks. And kind of shows you, be careful about buying just the index, because these stocks said if you just buy them, hold them forever, you'll do fine. Well, that's not quite the story. In the companies, or in the Nifty 50, we included Polaroid, McDonald's, Disney, Xerox, but the story doesn't end there, does it?
Yeah, there's a lot of big companies in the Nifty 50 that are still around today, and big players, obviously, like Disney and McDonald's, but then there's a lot that weren't. And what happened was in 1972, the S&P 500 PE was about 19. The Nifty 50 was more than double that at 42, and companies such as Polaroid, 91 was their PE, and Avon was 65. And then what happened was in 1973-74, the market fell out. Why? Because things got overpriced. The Dow fell 45%, and Xerox 71%. Polaroid, again, had a PE of 91. Well, they fell 91%, and then Avon fell 86%. So these were these companies that were, oh my gosh, it's the next big thing. Polaroid cameras are going to be so awesome. Xerox, so awesome. Not so awesome.
And again, the Dow fell, you said 45%. A lot of it from these bigger companies that fell so dramatically. There's other companies that didn't fall as much because they weren't overpaid for. So again, the saying is, if you don't know and understand history, you're doomed to repeat it again. So again, we have companies now doing the exact same thing these did, and it's not different now. It's the same thing. It's going to happen to you again. And people, all this index investing, they're going to say, oh my gosh, I didn't know I could lose this much money. Go back, understand history. You understand that index investing by itself is not the right way to go. All right, let's talk about a company right now, General Electric, symbol GE, current price on 31.27, the high 33, the low 19.37. Go back to 2012, it's had a nice run up here, right now on 31.27. Let's look at some numbers here. What General Electric does, they do appliances, energy, aviation, healthcare. They're very diversified. They call it a conglomerate, what they're actually called. The sales up 6.8%, earnings up 740.6%. Not getting into details, but that was from accounting, some things they did with their numbers.
I would be curious on what the real growth of their earnings were, but debt to equity is 184%. Would want to understand that number. I know they still do some work in the financial world, so would want to understand what that makes up in the balance sheet. They do pay a nice dividend of 2.9%. However, it is approaching an uncomfortable payout ratio, as it's 85.8%. Makes me question, how much are they investing to grow the business if they're using that much of their earnings to pay out a dividend? Going forward, December 2017, estimated earnings per share on a GAAP basis, $1.62. Target sell price, $26.73, so below that current price. Again, don't overpay. GE was actually another company in the Nifty 50.
Right, so great company, just a little bit pricey now, so again, be patient. Well, I hope you enjoyed this edition of the Smart Investing Daily Briefing. If you'd like the free report on the 5 big mistakes investors make,
give us a call at the office. Our phone number is 858-546-4306. And if you've missed any previous Smart Investing Daily Briefings, go to our website, smartinvesting2000.com.